All right, let's take a look at Treasury yields this morning. They're a little lower than they had been earlier in the week, but we are talking about elevated levels that's been taking course all week since the Moody's downgrade last week. The 30-year this morning is at 5.03%. The 10-year is at 4.52. For more on this week's action in the bond market, we want to bring in Subadra Rajappa. She is the head of U.S. rate strategy at Societe Generale. And Subadra, let's run through what we're talking about here. Ray Dalio has a warning that's out there. He says, I think we should be afraid of the bond market. I would say that if we're really looking over the next 3 years, to give or take a year or two, that we're in a type of critical situation. Do you agree?
Yeah, we're definitely at levels that we should be concerned about, 5% in 30 years. And if for some reason, if we start seeing a continued sell-off in the 10-year towards that 5% level as well, that I think is a bit of a concern. But this is not just a U.S. phenomenon. You're seeing global bond yields rise. You're seeing this unraveling of correlations between all the different assets. I mean, typically when equities sell off, investors flock to the safety of bonds and the dollar. That's not happening. And you're also seeing at the same time that investors are really demanding a term premium for bonds, not just in the U.S., again, also globally with JGB yields going higher. So you're seeing this kind of very, difficult picture, if you will, for bonds globally.
I mean, 5%, I know that's at the very high end of things over the last 18 years. Mm-hmm. But if you look historically, it's really not subnormal, out of the norm. And we've seen rates that are much higher than this going back historically. Is this really the bond market sitting up and saying we're not going to continue to allow these global fiscal deficits to continue?
Yeah, for sure. I think this is bond vigilantism at its early stages. I mean, we saw that back in August of 2023 when the Treasury increased its coupon issuance sizes. You saw bond investors push back and 10-year yields started going towards 5%. So this is definitely the bond market kind of sounding the alarm, if you will, on the fiscal situation in the U.S. as well as globally. You're also seeing that the Fed is doing quantitative tightening. So the largest buyer of Treasuries is stepping away, and the demand dynamics are generally quite weak as well.
Subadra, you are stressing that it's a global phenomenon. I'll tell you where I'm going with this. For the second day in a row, and we understand the journal, but they're running interference for this reconciliation bill. They're saying, do not blame the backup in yields to what is a pro-growth tax cut strategy. But then others are likening it to what happened in the UK with Liz Truss, which resulted in her the country backtracking on all the tax cuts, and now they're stuck in kind of a malaise. Do you tie this back up directly to the reconciliation bill, or why did the light switch go on 37 trillion? Why did it just happen now that, wow, we might have a problem here?
So it's really a confluence of factors, and I think we've been building up to it for a while now. I would say that starting with the Liberation Day on April 3rd, you saw the initial reaction in the bond market was towards lower yields as equities sold off. And then we quickly reversed course when uncertainty started to rise. And then we got the downgrade from Moody's last week. So,
Did
this
that
sort of
really
fiscal,
mean anything, though?
not really. I mean, I think that this is one of many data points that we're looking at. If anything, I'd say that the bill that's been passed in the House is better than what I had anticipated. The question now becomes what happens.
Better how? Because of cutting the 1.5 trillion or whatever.
I mean, the pushback has come from the deficit hawks, right?
I mean, this adds to the deficit.
It does add to the deficit, but they've tried
to keep selling the growth.
But can you have a pro-growth bill if you're doing this in conjunction with changing the tariff structure in the United States, around the globe, actually? I mean, I think that would be the bigger question. Is it going to be pro-growth if you do it hand in fist with the tariff?
I think Becky has a very good point, because this comes in the broader context of what's happening with tariffs and what the impact of tariffs are going to be on inflation. Is this sort of pro-growth tax policy going to be an offset for the higher prices that consumers have to pay because of tariffs? And this package is not as stimulative as it was back in 2017 when the first sort of tax cut was passed. So the market's trying to suss out all of these different outcomes, and you're seeing this rise in yields.
And taxes aren't going up. So to service the debt, we need the growth to work. We need the growth components to be positive. So that's another thing people were, I thought it was sort of an inverse way of looking at it, that the worry is that there won't be enough tax revenues because we won't have the growth. So interest rates are going to go up because we're not going to be able to service. Well, the 20-year auction might have been the first sign of that. No?
Yeah.
Yeah?
For sure. I mean, I think that long end yields are rising, and really the buyer's strike is in the very long end. I mean, the 10-year is still relatively contained.
Yeah.
I think that over the next 3 months, 10-year yields probably trade somewhere between 4 and a quarter to 4.75%. I think you start getting towards
but
5%.
You're not going to get the relief on things like mortgages, car loans, all of the things that drive the consumer.
Yeah, and you're seeing that play out in the data with existing home sales, starting to weaken. You really need to see that 10-year yield start to come down towards that 4% or below to see those borrowing costs start to ease up a bit, and you're just not there.
What if it gets bogged down in the Senate, and it doesn't look like we're going to get there, and the tax cuts would expire? Would that be good or bad that this didn't go through?
We know that it's going to be categorically bad, right? When you don't pass an extension of the TCJA, that's implicitly a hike in taxes. So the extension of the TCJA is going to definitely get passed.
I heard people yesterday saying we need to go back to 39.7. I was watching it yesterday. That's something we should do at this point. Is go take the high end back up for, I think it was Harold Ford actually saying that on.
You do that overnight, you're going to face a severe crunch in the economy, I would say.
Yeah. And the implications are going to be sort of broad ranging. It's not just the bond market. You're going to be looking at risky assets, broadly speaking, and saying, what are the implications for equities and credit and all the other asset classes?